Welcome back. Today, non-farm payrolls rose by 187,000 July, above market expectations of 170. However, negative news. June and July were revised down by a total of 110,000 jobs to 105 in June, 157 in July, respectively. The unemployment rate also rose to 3.8%. This is the highest high we've seen in unemployment rate in a while. The average hourly earnings were at 4.3%, less than the prior and the expected number of 4.4. The labor force participation rate rose to 62.8 from 62.6. That's probably the one bright piece of news on this month's report is the labor force participation rate. Here we can see non-farm payrolls again rising to 187,000 versus the expectation of 170, but the prior 2 months were revised down. And really, we see the non-farm payrolls taking a look at the big picture going back to mid 2021. These are some of the worst numbers we've seen over the past couple of years. This is non-farm payroll year over year, comparing this August to the last. And we can see this August to the last, we're down about 50% or so. The prior 2 months down even more than that. And I think it's important, like the housing numbers, also employment numbers do have seasonal patterns. Employment is different in August than it is in December, for example. So, that's why we compare on a year-over-year basis, and it certainly does look like a negative. The unemployment rate ticked up to 3.8%, and we can see here this is the highest high we've seen in quite a while, going back to mid-2022. The white line's the S&P 500, and historically speaking, when we see the unemployment rate go up, we see stocks go down. When the unemployment rate goes down, we see stocks go up. However, now we see the unemployment rate going up despite rather or relative strong stock markets, and traders may ask, where's the disconnect? Here's the unemployment rate year over year, just slightly to the positive side, really unchanged. We would like to see, especially taking into consideration the relatively strong stock markets. The question is, why is the unemployment rate not going down on a year over year basis, especially? Here's a zoomed in view of that. Again, we're just a little bit above zero, which is not a good thing, to be sure, about 1% up year over year. But given the stock market's been so strong, especially since October of last year, why is the unemployment rate year over year going up? Wouldn't we expect it to go in the opposite direction? Here's average hourly earnings, which on the surface looks good. Average hourly earnings goes up versus the white line, that's the S&P 500. However, when we look at average hourly earnings on a year-over-year basis, we tend to see actually the numbers get worse and worse over time. Peaking out the beginning of 22, which was coincidentally the top of the stock market. We've seen this pattern over and over again. There seems to be a disconnect with relatively strong stock markets, stronger than what we would expect given the economic numbers. Here's a labor force participation rate. This is the one bright piece of news over here, which is ticking up now to a level we have not seen actually going back to 2020, which does agree with strong stocks. We would like in the near term future to take a much deeper dive into these employment numbers. It's one thing to say the labor force participation rate is strong and improving, but that just means that there's more of us engaged in the labor force. But maybe how many of us need a second job to supplement what we would only have needed one job, to cover the bills in the past? So this on the surface looks good, but again, it's only a surface number. Here's a labor force participation rate on a year over year basis, and it is improving. It is going up compared to last year. And again, this is probably the one bright spot of this month's employment report. Here's the unemployment rate on a state by state average. Now, if you take what we've been discussing as a federally, registered or published unemployment rates, if we take every state and we take their individual unemployment rate and average them all together, this is what we see, the red histogram bars. And this is good. We see that over time it is going down, and we're approaching that 3% level versus the white line, the S&P 500. But this compares every state equally weighted, and certainly some states are a lot larger than others. Some states, benefit from some industries and others in other industries. So maybe it's not a fair comparison to compare the small states to the big ones. But if we were to, we would see overall, we see the conditions are improving. This shows us every single state's unemployment rates, and we can see it's not important so much which line is which, but more the pattern that we're all very much consolidated towards the center compared to where we saw in the past. 2021, we had some states with an unemployment rate of 3% and others with an unemployment rate of 9% almost. Now it's very much consolidated, except for a few outliers. I believe that's Nevada at the top, followed by the District of Columbia. But for the most part, what the conditions that are affecting one state unemployment rate is affecting the others more or less in the same way, and that's a good thing. Here we can see a 93% chance now that the Federal Reserve will not raise rates and keep them unchanged at the current 5.25 to 5.50 range. There's only a 7% chance that the Federal Reserve will raise rates to 5.50, 5.75. Now we've seen going back since uh, actually about let's say the third week in August, we saw a 78% chance the Federal Reserve was not going to raise rates. Then we had the Fed summit prior to that, actually. Fed Bauman speech, Case-Shiller, home price index, a soft GDP number. Yesterday we had the personal consumption expenditure, and Fed Bostic spoke. And then, of course, today, a non-farm payroll number. We really see a tale of two cities over here. On one side, the soft numbers, which include today's employment levels, and also taking into consideration it revised down the last 2 months' employment levels as well. So today's number really is not good. 2 days ago, we had a soft GDP number, what, 2% versus 2.4? That was not good. Case-Shiller Home Price Index, that was not really anything to celebrate. So these soft numbers move the Fed further away from raising interest rates, and that is in accordance with a 93% chance that in September, the Federal Reserve will in fact not raise interest rates. However, on the other side, we have the Jackson Hole Fed Summit, Fed Bauman speech, Fed Bostic speech yesterday, and all these Fed speakers are singing the same tune. They're saying we have a 2% target, employment market. Well, yesterday, Fed Bostic from Atlanta, he actually said that the labor market might be cooler than we think, which, is actually the case, what we see right now today. But overall, he says the Fed has a 2% target and we will not waver. We will continue to raise rates until we reach 2%. Right now, as of yesterday, actually, PCE, personal consumption expenditure, was higher than expected, up to, I think, 3.4%. So inflation is not only well above 2%, as of yesterday, it's actually moving in the wrong direction. It's going up. So, with that said, we have a tale of two cities. On one side, we see that the Fed says we're going to continue to raise rates, and inflation is telling us that we need to continue to raise rates, and we have a 2% target. We're not going to stop till we get there. On the other side, we have weak employment numbers, weak GDP numbers, home price numbers, and many other numbers before that, during the course of this month. So at the moment, the Federal Reserve, the Fed funds futures are telling a 93% chance that we will not raise interest rates in September. Looking further on down the road, I think we certainly could expect higher rates to come. We hope this has been helpful. We look forward to seeing you back soon.